So let's talk a little bit about the big picture. So first, we're in a really bullish market overall. I know we've pulled back a bit overnight with oil coming up, but quite frankly, it does send the point home of really the kind of trading environment we're dealing with right now, which is one where there is very little fear. So let's get into some of these charts. First, I'm starting to look at silver with a little bit more interest here. I think it could become a more bullish setup. But we do need to see progress in the war. We do need to see progress opening the strait, or at least getting some more energy supplies into, especially China, but various parts of Asia. China is the world's second largest industrial user of silver, and industrial use of silver is the primary use case. Speaking of interesting divergences, we also have inverted Brent crude oil in the S&P, and this chart's just a couple days old, but it sends the point. There's this dramatic divergence here. One of these markets is more likely right. The question is which one. And speaking of oil through the strait, there's basically none passing through. We can see that tensions are flaring up again this morning. Oil is really well bid ahead of this market open. That's causing some pressure in futures as well. We also have a rather dramatic risk off in software. Hedge funds want nothing to do with software. They have lowered their overall net exposure to levels we haven't seen in years. Now, I don't think the entire software basket is a buy, but I do think there's companies within it that look more attractive once this whole thing fleshes out. Companies like Intuit, companies like Palantir, companies like Cloudflare. There's a lot of software companies to keep on your list, but we've got to wait for momentum to shift to favor buyers again. We also have a market that is pricing in essentially flawless earnings and the highest level of earnings growth that we've seen in decades. Now, this could entirely be possible, although it's interesting because typically during the first quarter of the year, you see downward revisions. This time we're not. We're in fact seeing upward revisions, and Wednesday is going to be, and that's tomorrow, the biggest day of this earnings season because we've got Microsoft, Amazon, Meta, Alphabet. I mean, this is insane, all in one day. None of these Wall Street analysts are going to be getting any sleep at all. We also have emerging markets starting to look a little bit more attractive. Speaking of earnings, their forward PE is at some of the lower levels we've seen over the last couple of decades, which tells me as long as we have a path to decreasing tensions in the Middle East, there are opportunities to bid these. Personally, the trade that I've liked, that I've had TraderAid members in emerging markets, is long Brazil because it benefits from the emerging markets trade. It has a similarly cheap valuation, but it also has upside with oil moving higher. And then speaking of the other side of things, expensiveness. This is the semiconductors index, and you can see it is trading at a PE close to 60, and it's trading to a price book ratio close to 10. These two things give us a sense that that whole space, with exceptions within, I know Micron's trading at like a forward PE of 6 or something, but overall this space is looking a bit more expensive. It's also a bit crowded. That doesn't mean don't be long. It means mind your risk. And here's a chart of the NASDAQ 100 seasonality, which is set to continue improving. We'll probably see a little bit more sideways action in May if past is prologue. I got a lot of flack posting this last week before the market rocketed higher because folks were saying, oh, but this is the midterms. So we have to throw away all of our other seasonality charts and just focus on midterm years over the last 75 years. Doesn't matter. And going back that far often is the case. It's not really that helpful. The most I'll look back is 20 and most of the time 5. So here's a 20-year look back all years. And typically May is a little bit more choppy. We get a nice rally into May as we are. And then summer is really where the market likes to take off in the NASDAQ. It's also been a very narrow breadth rally. So that means that we've got a handful of tech stocks really leading the market higher. Sound familiar? We've been here before, and that's fine. The market can continue to grind higher on that, but we have to remember that concentrates risk into a handful of names. Now let's get a little bit into the technicals and momentum, and then we are going to go live with Bookmap. First, the weekly pivots, and I'm going to share this on social. So these are the pivots that I look at to be bullish above and bearish below. that's out there. You're welcome to screenshot it as well. Let's go into the S&P 500 futures chart. I've switched up the moving average that we're watching on this chart to the 8-day because of how sharp this rally is and how it's interacting with the 8-day moving average. I think if we do slip below it, you're likely to see risk off in terms of sellers starting to gain a near-term advantage. So for now, as long as we're above that 8-day EMA, I'm okay. Similar look on the NASDAQ, really looking at that 8-day EMA on the sharper rally to help us get a sense as to who's got an edge in near-term momentum. So far, both on the S&P and NASDAQ, that is the buyers for now, but if we break below that on a closing basis, it's going to be the sellers. Looking at gold futures, I like this chart. I actually think this looks pretty bullish. I am looking for a break above, and if we can get a break above this descending trend line, I'm looking for us to try to hit new all-time highs. So 6,000, if we can make a convincing break above this descending trend line, would be my next target. Silver is a little bit more challenged here. We don't have the same exact bullish setup, and we also have the industrial use case under a little bit more pressure because of what's going on with energy. So I'm really just looking for silver to hold this upper trend line. I'm not quite as excited about near-term upside yet. And crude oil seems to be trapped in this range. If we look at this weekly chart, we've largely been kind of trading around this. We do appear today to have some momentum to potentially push towards the upside. If we're able to break out of this range, I think we're going to get back into triple-digit oil as the sort of de facto level. Trading between $100, $120 would not be particularly surprising with the strait staying closed for as long as it is, but also seeing some signs that the amount of time it could take to get things back online could be longer than what the market's pricing in, even if it opened tomorrow. Then we have Bitcoin. Bitcoin actually starting to look a little bit more bullish, but I don't think we're out of the woods until we take out this overhead resistance. So we at least have been able to break above this descending trend line, but we do have a formidable area of resistance overhead that bulls would have to smash through and hold above to tell me we're out of the woods. So markets kind of in this environment. We're so back, it's so over, depends on where you look. And just quickly looking at options, we've got pretty decent resistance at S&P cash 71.75. There's about a 26 handle delta between cash and futures. Got the gamma flip below us at 70.27, and then a big vol trigger level at 7,000. We wouldn't want to get below that 7,000 level, especially on a closing basis. Really would give sellers a near-term advantage to be below the gamma flip and vol trigger. That would likely take us down to that put wall around 6,800.